H.R. 1, also known as the Big Beautiful Bill, has officially passed, and it brings with it some of the biggest changes to the tax code we've seen in years. If you're confused about what actually changed, what stayed the same, or how this is going to affect your taxes next year, you're not alone. So, in this video, we'll look at 12 major tax changes in that new law. We'll go over what they mean, who they affect, and what you need to know to prepare. Let's start with the changes that affect individual taxpayers. Number one, the individual tax rates are staying lower. So, back in 2017, a law lowered the income tax rates for most people. That meant you paid a smaller percentage of your income in taxes than before. But those lower rates weren't permanent. They were set to go away in 2026 unless Congress made a change. The new law keeps those lower rates in place permanently. So, if you're used to your tax bill looking a certain way, those brackets aren't jumping up next year. This affects everyone who pays federal income tax. Number two, the standard deduction increase is permanent. The standard deduction is part of your income that the IRS lets you subtract before calculating your taxes. It's automatic and you don't need to keep receipts or itemize anything to take the standard deduction. In fact, most people take the standard deduction. So back in 2017, the standard deduction nearly doubled. That meant less of your income is taxed. Like the tax rates, that higher amount was set to expire. This law makes it permanent. So for most taxpayers, nothing changes. You'll still get that larger deduction. Number three, the SALT deduction limit increases. If you itemize your deductions, you can write off what you pay in state and local taxes. That's called the SALT deduction. But since 2018, that write off has been capped at $10,000, no matter how much you actually paid. That limit hits people hardest in states with high property taxes or high income taxes. So the new law raises the cap to $40,000 for joint filers and $20,000 for single filers, but it's only through 2029. It also limits the benefits to households making less than $500,000. After 2029, the cap drops back down to $10,000. Number four, the child tax credit is increasing. If you have kids, you might already be familiar with the child tax credit. It's not a deduction, it's a credit, which means it directly lowers your tax bill dollar for dollar. That credit has been $2,000 per child for the past few years. But starting in 2026, it's going up to $2,200 per child. This new amount won't expire. Just like before, the credit phases out if your income is above $200,000 for single taxpayers or $400,000 for married filing joint taxpayers. Number five, seniors get a new deduction. If you're 65 or older, the IRS already gives you a little extra in your standard deduction. But now there's a brand new deduction just for seniors. Starting in 2026, people over age 65 can take an additional $6,000 off their taxable income. This is in addition to the regular standard deduction and the existing senior add on. The idea is to give older adults a little more tax relief during retirement, especially since the promise to make Social Security non taxable didn't come to pass. Number six, the new deduction for overtime pay. If you work a job where you get paid extra for working overtime, this part is for you. Overtime income has always been fully taxed, just like your regular wages. This law creates a temporary deduction for overtime pay. So if your income is under $150,000 for single taxpayers or under $300,000 for joint taxpayers, you can deduct up to $25,000 of your overtime income from your taxes. That means that part of your paycheck doesn't count as taxable income. And this deduction is temporary, so it expires after 2028. Number seven, tip deduction. If you work a job where you earn tips, like servers, bartenders, drivers, or salon workers, this next deduction is for you. Tips have always been taxable, just like regular wages. Now you may be able to deduct up to $25,000 of tip income from your taxes. The caveat is that your income has to be below $150,000 if you're a single taxpayer or $300,000 if you are married filing jointly. And this deduction is going to disappear after 2028. This is meant to give some people relief who are in service jobs and rely heavily on their tips. Now let's talk about what's changing for small business owners. Number 8, the QBI deduction is permanent. If you're self employed or own a small business, you may have heard of the QBI deduction. That stands for Qualified Business Income, and it lets you deduct up to 20% of your business profit. This deduction was created in 2017 and was supposed to end in 2025. Now, the new law makes it permanent, so eligible business owners can keep claiming it moving forward. The income limits were also slightly adjusted, which may help more people qualify. Number 9, 100% bonus depreciation is back. If your business buys equipment like vehicles, mowers, computers, or machinery, you may qualify for bonus depreciation. That means you get to write off the full cost in the year you buy it instead of having to spread it out over time. Bonus depreciation was being phased out and was scheduled to drop to 40% this year. This law restores it to 100%, starting with purchases made after January 19th, 2025. It's going to allow you to deduct the full cost of those purchases right away. Number 10, full expensing for research and development costs. If your business does research and development, like creating new products, improving processes, or building software, this affects you. Under the old rules, you had to spread out those R&D expenses over 5 years. The new law lets businesses deduct 100% of those costs in the year they're spent. So instead of waiting, you can write off your full R&D investment right away. This is going to benefit startups and tech-focused businesses in particular. Number 11, the Opportunity Zone program has been expanded. Opportunity zones were created in 2017 to encourage investment in low income neighborhoods. If investors put their money into these areas, they could delay or reduce their capital gains tax. The new law extends this program and adds some extra benefits like longer time frames and more flexibility for reinvestment. So if you're an investor or looking to start a fund, this could be something to explore. It's complex, however, so make sure that you talk to a professional if you're interested. Number 12, startup deductions and expense rules have changed. Starting a new business can get expensive between licenses, branding, setup costs. It could run you into the thousands. There are limits on how much of those startup costs you can deduct right away. But this new law increases the amount you can write off in your first year and expands what kind of expenses qualify. The goal is to make it a little easier for new businesses to get started and manage their early year tax bills. So here's the recap. Some of these tax changes are permanent, like the lower tax rates and the QBI deduction. Others, like overtime and tip deductions, are temporary and they expire after 2028. Most of the changes take effect for tax years starting after December 31st, 2025. If you're an individual taxpayer, these changes might affect how much you owe or get refunded next year. If you're a business owner, it's worth paying attention to how your deductions and planning strategies might shift. This is Tasha with West Financial Services, LLC. Follow us for more tax strategies and education for individuals and small businesses.